The British are leaving. The British are leaving. Brexit has happened, but what does that mean exactly for TSP investors? Now, if you've been watching your thrift savings plan account and you've kind of kept up with it since Friday, you would have noticed that there's been some changes. Some of those changes are that you've probably lost a bit of money, okay? The Britain leaving the European Union has greatly affected the markets on a global scale, as I've said. Not just things like the I fund, which is an international fund. It's also affected the S&P 500, which is the index that the C fund tracks, the S fund as well. So there's things happening right now that are affecting your TSP, and you need to be aware of them and keep up with them. The European Union is a big union. It's got a lot of different countries, and one of the reasons that this is such a big deal is if Britain's leaving, who's to say that other countries won't follow suit and leave as well? Okay, that could have more impact upon your investments and just the US economy in general. I'm not going to go into too much detail on that part of things simply because you can find that information just about anywhere, but I kind of want to talk about how it specifically deals with the thrift savings plan. Now, the TSP is made up of 5 funds: the G fund, the C fund, the S fund, the I fund, and the F fund. Okay, that's, you know, you've got everything ranging from the government fund in the G fund that's guaranteed all the way to something that's very volatile in the I fund, which is international funds. Many of you are probably invested in probably all 5 of those if you invest in the L funds, or you're at least heavily invested in some of them and not so much in others. That being said, if you're invested in any of those, especially the C, S, and I, and possibly the F as well, you are affected by this. Now, the C fund, as I said, actually tracks the S&P 500. So the S&P 500 is the top 500 companies in the US. On Friday, when Brexit occurred, or when the decision actually came out, the S&P 500 actually lost pretty dramatically, and I actually have some stats here. When Britain announced they left, the S&P 500 turned negative for the year to date. So for the year to date, they were actually, up. There was actually an increase over the year, not a super large increase, but it had increased, and now for the year to date, due to Brexit, the S&P 500 is actually negative for the year, which also probably means the C fund is as well. Also, the TSP lost all the year's gains and suffered its largest decline since August of last year. Okay, now that's in the short term. I'm talking about things that are happening in the short term. In a little bit, I'll talk about what's going to happen long term. But the I fund also fell dramatically on Friday's news, going from 24.6 a share to 22.6615 in a matter of hours. Okay, the international fund is very volatile to begin with, but throw on the tumultuous situation that you have with Britain exiting the European Union, that's just throwing gasoline on a fire. So that's something to be aware of going forward. Now, these are short-term occurrences, but what's going to happen in the long term? That's really what you need to be aware of, okay? Because we don't trade the dips. TSP investors, there's very few that should actually trade their TSP account. The majority should be investors looking for the long term. And if you're looking for the long term, these ups and downs of the market shouldn't play as big a role in your portfolio. Now, do I believe that the US economy is going to sink due to Britain leaving the European Union? No. Is it something that could, have a impact or rock the US economy? I think yes. I think it is something that isn't just going to play itself out from Friday to a couple weeks from now. I think it's something that's going to, have a lasting impact for the next few years. And the reason is Britain leaving the European Union isn't something that happens like that. Britain leaving the European Union is something that's going to happen over the next 2 years, okay? This is a process. So within that process, there's going to be ups and downs, and there could be other countries leaving the Union, and all of those things can meld together and, leave for a big situation, not only for the global economy, but also the US economy and the US stock markets. Now, I think there's 3 ways that Britain leaving the European Union could actually affect the US economy. And the first one is it could strengthen the dollar. Okay, last week, investors, because they didn't want to be in the UK, they didn't want to be investing in pounds, they ran so fast away from that and they ran to the greenback, the US dollar, because it's strong. Okay, so I think people fleeing the UK and running to the US dollar, is something that can actually strengthen the dollar, which is a good thing. It could tighten financial conditions, tighten financial regulations. Anytime something happens in which a big occurrence happens, US government bureaucracies come out, and in order to essentially appease voters and to make them, realize that they are worth their salt and are doing something for their country, they will try to, stiffen regulations, and that's something that could happen in the future. And also it could hurt business confidence. Janet Yellen, the Federal Reserve chairwoman, said she believes the apprehensive private sector spending is one of her biggest worries. She came out and said, private investment has been very weak. That's one reason productivity growth has been so meager. Okay, but all this being said, the US economy at this point is still rather healthy. I think one of the important things that needs to be discussed is, what are you going to do going forward? In my opinion, you need to have an investment plan in place, a financial plan in place, so that occurrences like this aren't going to totally rock your situation. If you don't have an investment plan, if you don't have a financial plan, like many of you watching this probably don't, then in reality you do have a plan. It's just that your plan is planning to fail rather than planning to succeed when you have an investment plan, when you have a financial plan in place. Okay, for instance, if you're trying to travel somewhere, you're not going to get there without a map or a GPS, because you're just going to be wandering about on the streets trying to travel to, say, go on a vacation. Now, nobody would really do that unless they, were just careless and, wanted to have a crazy time. But you don't want to have a crazy time with your investments. You don't want to be careless with your investments. So you need a strategy to follow. And if you click up here, I actually have 7 tips that can help you develop an investment strategy. And I think it's helpful and something that you should probably check out. But if you do have a plan, if you do have an investment strategy in place, stick to the plan. Okay? It's as simple as that. You don't create a plan for short-term gains. You create a plan for short-term, or for long-term gains, excuse me. The plan is for the long term, so that you can retire comfortably, so that you can have the amount of money that you need saved up for retirement, and you're not worried about the ups and downs of the market, okay? Because you're looking to the long term. So if you do have a plan, I suggest stick to it. If you don't have a plan, create one now. Okay, this has been Cooper with FedRetirementPlanning.com. If you haven't signed up for our newsletter yet, click up here. I think it'll be very helpful for those of you that have. You actually receive this update in your inbox, and I hope this has been helpful to you. Comment, like, share, let me know what you think or other questions you have, and I'll see you guys later.